Welcome back. So in this video for Chapter 7, we're going to go into more detail in the flexible exchange rates with inflation targeting, flexible exchange rates with no inflation targeting, and fixed exchange rates. And we'll look at what will happen, with sort of macroeconomic shocks. We'll think about monetary policy, and we'll think about why countries might choose each of those options. All right. So just as a reminder, we've got our three exchange rates. Now, in the real world, of course, there's sort of lots of variations of these, but these are three sort of main buckets, right? So we've got a flexible exchange rate with inflation targeting. That includes the United States, the UK, Japan, the Eurozone as a whole, but not each individual country. Flexible exchange rates with no inflation targeting. So a lot more sort of developed countries that have a less developed sort of financial system, but especially sort of international financial system, and then fixed exchange rates. And so we'll start here with our flexible exchange rate with inflation targeting. And so this is the most common, especially for the more developed countries. And the key thing here is that changes in the exchange rate can make monetary policy, when they're changing the policy rate, more powerful. And so that's in some ways good and in some ways bad, right? It means smaller changes in the policy rate might have a bigger change. That can happen via aggregate demand, right? So if the central bank increases the interest rate, which we call tightening policy, that means that the exchange rate should appreciate, which then decreases exports, increases imports, and decreases aggregate demand, which is what the central bank is trying to do with tighter monetary policy. But it can also directly impact inflation, right? So a tighter policy is an exchange rate appreciation, and that can make imports more expensive. And so again, that can have a direct impact on monetary policy. All right, so let's think about what happens when a country gets a demand shock, right? So we start at A as before in our aggregate demand model. We get a shift up in aggregate demand. We move to B. We know, right, that moves us along our Phillips curve from A to B. And so we move from an inflation of 2%, where inflation is equal to expected inflation, to 4%. So what's going to happen? Well, now we know that inflation is higher than the desired goal, the inflation target. And so the central bank will increase interest rates. The exchange rate will appreciate. Now, why does the exchange rate appreciate? We're going to talk about that a little bit more towards the end of the chapter. But basically, with higher interest rates, people want to buy that country's bonds. And in order to do that, they need that country's currency. And so they will trade their currency for this country's currency, and that will increase the value of the currency. So that causes the appreciation causes a fall in exports, a rise in imports, and aggregate demand shifts downward, right? We also expect it to cause a fall in investment and potentially a fall in consumption. But that just means that it's all pushing us back down to A here. Now, the key, I think, to remember is that for a country like the United States, this is very much a secondary effect. Exports and imports for the United States are sort of in the 12 to 16% range. So not nothing, but not a huge amount of GDP. But for other countries, this can be very significant, right? So for other countries, trade can be 40, 50, 80% of GDP, meaning most of the stuff we produce, we sell overseas, and most of the stuff that we buy is produced overseas. And so on those countries, the sort of international trade aspect can be the main driver of monetary policy in a Flexit country. So just a reminder, sort of, or more detail here about the impacts of depreciation. So Here we have the consequences of real depreciation on the left and real appreciation on the right. And so the way this book defines it, real depreciation is an increase in C, what we call an increase in competitiveness. And a real appreciation is a fall in C, or a decrease in competitiveness. And so with the depreciation, we get an increase in demand for the country's exports because now those exports are cheaper, and a decrease in imports because those imports are more expensive. So net exports go up, and that should increase aggregate demand. On the other hand, with a real appreciation, net exports are likely to fall because we will sell fewer exports and buy more imports. And nominal appreciation means imports are cheaper, so that's going to reduce inflation. Nominal depreciation means imports are more expensive, so that's going to increase inflation. All right, so if we look at sort of two Flexit countries, so like the United States and Canada, the United States and the UK, we want to focus on sort of what's going on with the real exchange rate versus the nominal exchange rate. And remember that our real exchange rate C is equal to the nominal exchange rate E times this price ratio. P star is the foreign price level and P is the domestic price level. And so if we just take P star as fixed, right, then there's basically two ways that our real exchange rate can change, right? Can either appreciate or depreciate. One is a change in our own price level. So if we have high inflation, right, higher inflation than P star, then that will change C. And if we have lower inflation, that will change it. But if they're the same, then we would and they have similar inflation targets, right, which we would expect in two Flexit economies, then changes in the nominal exchange rate will lead to similar changes in the real exchange rate. So, for instance, if the United States has a 2% inflation target and the UK has a 2% inflation target, and they're both successful in keeping it around 2%, then we would expect changes in the nominal exchange rate to result in changes in the real exchange rate. All right, so now not all countries are Flexit countries, right? So let's look at a FlexNIT country. Remember, that's a flexible exchange rate with no inflation targeting. And so now this price ratio becomes really important. So now they sort of changed they didn't change it, but they're giving us our formula in a slightly different way. So we have the real exchange rate C is equal to the nominal exchange rate. Remember, that's E divided now by the price ratio. And since we're dividing it by the price ratio, the P star goes in the denominator and P is in the numerator here. And so this will increase if domestic inflation is higher than foreign inflation. So if our country is a FlexNet country and we have high inflation and our trading partner does not have high inflation, then P over P star goes up. That's in the denominator. So that means C will go down, right? Remember, C is competitiveness. So that's a real appreciation. And so we would lose competitiveness, and that means that our exports will be more expensive. People won't buy them. Imports will be cheaper, but that might not be enough to offset it. And so in this case, if we have higher than expected or higher inflation than our trading partner, we would need the nominal exchange rate to change in order to offset that. So let's think about what would happen with a positive demand shock in a FlexNet country, right? So we shift up from A to B. And now since we don't have inflation targeting, when inflation goes up from 2% to 4%, then we're like, okay, well, that's okay. We're just going to keep it where it is because that means we're producing more and our unemployment rate is lower. But now we know what happens if we don't increase interest rates, right? The Phillips curve shifts up because of higher expected inflation. We end up at C, so now we're here. And then the Phillips curve is the longer we stay at that higher level of GDP and that lower level of unemployment, the more the Phillips curve is going to shift up until eventually when we do respond and try to return to our uh, supply side equilibrium, Y0, we end up with, much higher inflation. And so that's the danger with not having an inflation target, right? Is that we end up with higher inflation, and we know that the only long-term equilibrium is at that, equilibrium where we're at the supply side equilibrium. So one way we can think about this is looking at the depreciation rate. Now, depreciation means something different when we're talking about like things like capital, right? Physical capital. That's how much it gets worn out. But I guess we can think of a depreciation rate for exchange rates as well. And so the depreciation rate here is the sort of the change in the nominal exchange rate. So E1 minus E0 divided by E0 is just saying, all right, well, how much did our exchange rate change over some period of time? And since we know that our real exchange rate is equal to E times P star over P, then the change in our real exchange rate, change of competitiveness, is approximately equal to the change in the depreciation rate, right? So the depreciation rate, the change in the exchange rate, plus foreign inflation minus domestic inflation. And so if C is constant, right, then we can just set that equal to 0, and then we move our inflations over to the other side, and we get the depreciation of the nominal exchange rate is equal to our inflation minus the other country's inflation. And so this is going to be a problem, right, if our inflation keeps being higher, because then our exchange rate is going to have to keep depreciating. And so that's where we can get in this sort of inflation depreciation spiral, right? And so this is really just sort of an infographic rather than giving us any data. But sort of what's going on is, we're looking at inflation, the price ratio, the nominal exchange rate, and the real exchange rate. And so we end up with inflation is equal to expected inflation. Then we get a positive shock. And then we have inflation is equal to expected inflation plus the bargaining gap. So that's increasing inflation. That's what's going on over here. We get higher domestic inflation, which means we have a decline in export competitiveness. Policymakers keep monetary policy loose, right, because there's no inflation target. The nominal exchange rate depreciates, so that's what's going on here. Remember, an increase in E is a nominal depreciation. That leads to an increase in the price of imports, and the only way that we can restore competitiveness is with a real depreciation, and so inflation just keeps going up. So the real exchange rate, goes up and then back down, and then up and then back down, and then up and then back down, but it's just going to be giving us higher and higher inflation over time, and that's not going to be good, right? That's how we can get trapped in hyperinflation. All right, so now let's talk a little bit more about fixed exchange rates. And so one sort of extreme example of fixed exchange rates is a common currency area. And the obvious example here is the Eurozone, where countries gave up their independent currency for a common currency. And so in this case, we have a shared central bank. There's the European Central Bank, which is in Frankfurt, Germany. And they actually act as a Flexit economy as a whole, right? In terms of the euro exchange rate floats against the dollar or the pound or the yen. But inside the Eurozone, they have a fixed exchange rate, right? So €1 in Spain is equal to €1 in Germany, and €1 in France, and €1 in Italy, right? And so they have given up monetary policy. There's only one monetary policy for the entire Eurozone, which is set by the European Central Bank. So now, is that a good idea or not? Well, it doesn't necessarily fix the real exchange rate, right? So we have a fixed nominal exchange rate, but we can still get changes in prices between the different countries, right? So Spain might experience a different rate of inflation than Germany or Italy or France. Um, and so in that case, so even though the nominal exchange rate here is 1, we can still get changes in the real exchange rate due to different rates of inflation. And so what is that going to look like? Well, so here's an example, looking at Spain, right? We get a positive demand shock. We move from A to B. We get higher inflation. What does that mean? Well, for a time, we're at higher output, but then we will eventually decrease. We'll have higher inflation, which will eventually decrease, and our real exchange rate will eventually decrease. And so, I think the key here is what does monetary policy do? If monetary policy, responds more quickly, then we might, actually get back to inflationary targets more quickly, uh, which would mean that our real exchange rate would get back to where it was. But the fact is that when one country gets a shock that other countries don't feel, right? When they have a flexible exchange rate, one way to respond is through a nominal depreciation or appreciation, which adjusts, prices more quickly and helps the economy either recover from a negative shock or move back to equilibrium from a positive shock. But that is not open to countries in a common currency area. So if we compare sort of flexible exchange rates with inflation targeting versus common currency area, um, the Flexit economy, changes in aggregate demand can be really quick, right? Especially if they are a very open economy, meaning they have a lot of trade. And so central banks' changes in the policy rate can make very quick changes to the exchange rate. Um, and prices won't respond as quickly. And so we would get, a real appreciation or depreciation, which would offset, whether we got a negative shock or a positive shock. Whereas common currency areas, right, there's no change in the exchange rate. And so the only way that we can sort of adjust is through different levels of inflation, right? Domestic inflation versus foreign inflation. And that tends to take a longer time. And so, after the financial crisis, we saw that the Southern European countries like Greece and Italy, Spain, Portugal, had much worse shocks than the Northern European countries. But they were already in the euro. And so it did take a long time for those countries to recover. They did eventually recover, and partly that was through different levels of inflation, but it took a while. So if we think about sort of long run inflation in our common currency area, um, the only way we are sort of at our supply side equilibrium, right, is if we have equal levels of inflation, right? And so our depreciation, in this case, if our depreciation is 0, then we have constant inflation. But if not, then we need to have changes in the price levels. So if the fixed exchange rate economy, has that E equal 1 for everybody, then delta must be 0, and so inflation has to be equal to, has to be the same in all of the different countries, and that's not always the case. So then, one obvious sort of question then is, well, why would we join a common currency area? Partly, so if we think about the Eurozone, a lot of it had to do with political reasons more than economic reasons, right? The whole sort of European Union goal was to prevent another war, right? They'd had World War I and World War II, and they're like, really, we need to make sure that we don't have another war, and so we're going to be much closer. It also, of course, makes trade much easier. And in the Eurozone case, people are allowed to move freely between the countries. Um, and so that can have some benefits. But, if we compare, for example, the United States, which is obviously a common currency area within itself, and the Euro uh, common currency area, one of the biggest differences is that we have sort of much more common fiscal policy in the United States. They have some sort of common fiscal policy, but maybe not as much as the United States in the Eurozone. But also, we have a lot more internal mobility. And even though in the Eurozone you can move from Italy to Germany or Spain, it's much more difficult because of different languages and cultures. All right, so this is just a table looking at the three different exchange rate regimes. Just keep in mind that with fixed monetary policy, fixed exchange rates, excuse me, you don't have your own monetary policy, and that can be a problem, right? Whereas with flexible exchange rates, you do have your own monetary policy. And the danger with the no inflation targeting flexible exchange rates is that you don't have that anchor, right? And it can be destabilizing potentially, where inflation just gets higher and higher. All right, so we'll stop there. And in the next videos, we'll look more at sort of global capital, why global capital moves from one country to the other to other countries, what are sort of some of the benefits of global capital, but also what are some of the costs, especially since it's so mobile.